Okay, good morning, everybody. So I hope that everything is working fine, that you can hear me, and that all of you can see the PowerPoint presentation. That would be important to me. Can you just confirm that you can hear and see me normally, that the quality of the video and audio is good? Okay, there is nobody here. So this is the first lecture for this week. I hope that everybody is safe and healthy. So this is the way we will be doing the lectures until the end of the semester. I will be splitting up all lectures into two parts, just as we did during the regular lectures on campus. The live streaming times will be usually during our class times, 9:30 in the morning, if not otherwise indicated. So sometimes I might move it for another slot, but usually this will be the time for streaming the lectures online. I will also create discussion groups on Canvas for all of you to ask questions or make comments about what you read, what you saw in the videos, and the questions that you might have about what you read in the book and so on, as well as to comment on the current political and economic issues, especially when it comes to the situation with the virus quarantines and the possibility that we're gonna hit recession in this country and in the better part of the world in 2020, in the second and third quarters. Okay, so with that being said, let us get going. So today we will be dealing with the chapter on GDP and macroeconomics. So this will be a basic introduction to macroeconomic principles involving a few things: the definition of what is macroeconomics, definition of basic measures or the basic measurements that are part of the macroeconomic theory, such as inflation, unemployment, public debt, total spending, and so on. And finally, a few words about business cycles and recessions, one certainly hot political and economic topic right now. So let us get going. So let's start with the definition of macroeconomics before we plunge more deeply into the debate about the details. I will just remind you something that we basically stated or faced on day one of studying economics. That's the difference between micro and macroeconomics. Microeconomics deals with the theory of prices of individual goods and the theory of behavior of individual discrete economic agents, such as firms, individuals, and households. How firms, households, and individuals make their decisions to maximize profit, income, satisfaction, and so on. How they make economic decisions. So that's the reason why microeconomics is a theory about small discrete things, small discrete units of the economic system, and how the decisions are made within these units. Macroeconomics tries to study the economy as a whole, to understand the economic processes at the level of the economy as a whole, not just by looking at individual actors and individual discrete units of the economic system. GDP is a name for something that is called gross domestic product, and that is a basic measure of economic well-being in the entire economy. Gross domestic product means the value of all goods and services, final goods and services that are produced in a given country over a period of time. So that's the basic measure of the macroeconomy, the thing from which we start whenever we want to analyze macroeconomic theory, macroeconomic policy. GDP is the basic indicator how well an economy is doing. And now everybody is freaking out about a possible recession in this country. How do we know that recession is going to happen? We will know whether it happened or not by looking at the GDP growth rates. So that means that GDP is the value of all goods and services, final goods and services that are produced and sold in a country over a year. And we will see next year if the GDP figures, if the total market value of all goods and services is lower in 2020 than it has been in 2019, then we say, oh, we are in a recession because GDP has gone down. GDP as a measure of income and spending in a given economy. Okay, so bear in mind, this is the basic definition of economic well-being. We will see in a bit that there are some complications about GDP, that there are different kinds of measuring GDP and that there are different types of GDP, but for now, just stick to this basic point. The gross domestic product is a basic measure of income and spending in any given country, and the most important indicator of the economic activity in any given country. So what is GNP? So there is a difference between GDP and GNP. GNP means gross national product. So what is the difference between gross domestic product and gross national product? Simply, GDP means the value of final goods and services that are produced in a given country, which means by all the residents of that country. So for example, in the United States, GDP of the United States involves income produced by all people who live in the United States, irrespective whether they are citizens or legal residents or even illegal residents in this country. All people who live in the United States produce GDP. GNP is the value of final goods and services that are produced by all citizens of any given country. So that means American GDP is produced by everyone who lives in the United States. That's why it's called domestic, gross domestic product, whereas American GNP is the value that American citizens produce no matter where they live. So Americans in Canada, Americans in Switzerland, Americans in China produce American GNP and contribute towards production of the GDP of the countries of their residence. Okay, so this is the fundamental difference that we have to bear in mind. GDP is the production by residents, GNP by citizens, no matter their country of current residence. Okay, so the easiest way of thinking analytically about GDP is actually there are two ways. You can think of GDP as a spending, as the total spending in the economy. We can then define GDP as the total spending on final goods and services produced by residents in a given country. Or you can think of it as a total income. So there is no difference. These two are just the two sides of the same coin. If you and me were the entire economy and I spend $100 on the goods and services that you produce, actually our GDP would be $100. So $100 will be my spending and your income. But the total value of goods and services that we produce in exchange would be $100. It doesn't matter whether we look at the economy from my point of view, which would be the spending, or your point of view, income, that you receive the money. So however you count it, however you slice it, however you calculate it, GDP is what it is. Whether you use the spending method of calculating it, so you sum up all sources of spending in the economy and then that's your GDP, or you calculate all sources of income. Income always has to equal spending. Every dollar that is spent by somebody is $1 of income that somebody receives. Okay? So let me see if you have any questions. Not yet. Good. Seems that we might be having some slight problem with streaming, so I'll try to continue. So for our analytical purposes, it's easier to calculate GDP by using the spending model, which means that we add up together all sources of spending in an economy, and that would be our GDP, or our total or aggregate level of spending in the economy. So if you do so, if you break down all major components of spending, on which goods and services, on which components people spend money, we will find some 4 distinct elements. So this is the equation here in the second row. Here the GDP equals C plus I plus G. This is a double entered I. C plus I plus G, forget about the second I, that's a mistake, minus net exports. I'll explain what is that in a moment. So C is consumption or consumer spending. So 60 to 65% of everything, of total spending in any given economy, is actually consumer spending on durable and non-durable consumer goods. What is the difference between durable and non-durable consumer goods? For example, cars or apartments would be durable goods, whereas food and clothing and gasoline would be non-durable goods. So you see, this is pretty significant component, 60% approximately of GDP, and that's the reason why economists are so much worried about consumer confidence in the economy. So if consumers are not spending enough, that hits disproportionately the GDP figures. Whether an economy is going to grow depends on whether GDP is going to grow or not. And whether GDP is going to grow disproportionately depends on whether consumers are going to spend. Okay, so now one of the primary reasons why American economy is projected to shrink, to decline in the second and possibly in the first and possibly second quarter of this year is that consumer spending declined dramatically in this economic crisis right now. So that's one important component. The second component is investment spending. So these would be the purchases that businesses and firms make on everything that they use in the production process, such as machinery, tools, real estate, commercial real estate that is used as office space, factory space, and so on and so forth. So purchases that firms make of machinery, tools, and other goods that are used in the production process. So that's the second important component. The third component is government spending. So government spending is included into the total level of spending, and government spending is pretty significant. In the United States, it's about 25% of GDP, but that's just federal spending. When you add up the sources of state and local spending, that's even more. So that's the third component, and the fourth component is a net exports. So what is a net export? That's a difference between exports and imports. Okay. So if this difference is positive, which means that we export more than we import, then GDP is going to grow. GDP is going to be bigger. If the difference is smaller, if the volume of our imports is greater than the volume of exports, that would be called the trade deficit, and that would reduce our GDP. So for GDP figures to increase, it's better to have higher exports and lower imports. Now, why is that the case? Why GDP, why exports counts towards GDP as measured by the level of spending, and imports doesn't count. The basic reason, the main and the most important reason, is actually that exported goods are sold by domestic firms, by domestic entities to foreigners. So foreigners pay to our domestic producers the money, and money enters our economy here. So the total level of spending in our economy increases as a consequence of selling a good to a foreigner. So it doesn't matter from a standpoint of GDP accounting, it doesn't matter whether a domestic firm bought a piece of equipment or machinery from domestic seller, so then the component I is going to increase, or whether, for example, a Japanese firm ordered a piece of equipment or machinery from an American firm, the dollars are going to end up in the pockets of a domestic firm equally in both cases. So then the net exports component will increase. So in both cases, GDP will increase. So that's the reason the exported goods are actually paid in dollars to domestic residents, so money stays in the economy. Similarly, or actually the opposite of that, is the imports. When our domestic entrepreneurs are buying stuff abroad. So eventually we are using money, income that is earned domestically, converted into foreign currency, and buy stuff abroad. So money is flowing out of the economy. So actually the domestic GDP is not going to increase as a consequence of that, is going to decline. So then if you on balance have higher imports than exports, you will have more money outflow, you will have more money that is leaving the country, more income reduction on that account. Whereas if you have a trade surplus, then you will be receiving more money, income from foreign trade than you provide to foreigners. Okay, so that's just the basic accounting of GDP. One important, one kind of interesting side note here would be when you compare American GDP to European and Americans to Europeans. This percentage here that I was talking about, 60% in the United States, is higher in the United States than in Europe. And why is that the case? The main reason is actually the consumption taxes that penalize consumer spending, such as value-added tax or other sales taxes and so on, in the United States either don't exist or are very low, whereas in Europe they're very high, and that discourages spending and encourages forced saving. So what does that mean? That your total income is always equal to the sum of amount of saving plus amount of spending. Now, your saving as a percentage of your total income for any individual and for a country as a collection of individuals is called savings rate. When you divide the amount of saved money that you have by the amount of your total income, you get the savings rate. Okay, so now one of the reasons why the savings rate is typically lower in America than in Europe is actually that consumption is encouraged in America by low taxes on consumer goods, whereas in Europe those taxes are higher, so then the Europeans are spending less and they're deciding to save more. They decide to save much more than they would have done otherwise, because it doesn't make much sense to lose so much money on spending on artificially expensive goods. So that's one of the main points here, that the European consumer goods, because of higher taxes, are usually more expensive. So then Europeans save greater parts of their income than they spend. So this has been historically the case in the last couple of decades, if not longer. Okay, so GDP is the basic accounting unit that tells you how well an economy is doing, And the most significant way of gauging the economic health of the economy is to look at the growth rate of GDP between 2 years or between two data points, whatever that might be. So if GDP increases by a certain percentage, then you can talk about the economy growing or economy being in a good shape, and vice versa. If GDP is declining, then you talk about recession or economic problems, and so on. So GDP measures, just to repeat, the value of all final goods and services that are produced by residents. Now, GDP has certain shortcomings or certain limitations. So the value of basic goods and final goods and services is accounted for, but there are many things that are not measured by GDP that are nevertheless very important for an economy, for the wealth and income of the residents of that country. One of them are stocks and bonds. So the value of stocks and bonds doesn't enter into the GDP calculations. So why is that the case? Simply that's the case because the purchases or exchanges of stocks and bonds do not result directly in any increase in final goods and services. Stocks and bonds are not final goods and services. But yet it's very important. Why? Because stocks and bonds are means of saving and investment. Whenever you buy a stock or whenever you buy a government or private bond, actually you are saving parts of your income and lending parts of your money income to somebody else to invest it into production of future goods and services. So when the value, people are freaking out now because of the stock market decline, not because we are losing currently now many units of final consumer goods, but because the stock prices and bond prices are a reflection of the expectations of the business community about the future value of production. Less stocks and bonds being bought and sold today means less investment and less production in final goods and services tomorrow, 3 months down the road, 6 months down the road, and so on. So the stock market prices do not enter, and the value of stocks and bonds being traded on the stock and bond markets do not enter into the calculations of GDP. But they're nevertheless very important for understanding what's going on in an economy. Also, changing the value of existing assets, appreciation or depreciation of investment goods. In the meantime, that's not counted because that's something that is happening on an ongoing basis all the time, and GDP can count, GDP can measure only the transactions that are carried out on the market. If you sell something, if something is sold for $300, something is an asset or a machine, for example, it's been sold for $300 or $3,000, and the value of that thing appreciates to $4,000. This is not reflected in current GDP figures. GDP measures, GDP calculates only what is being achieved or what is being carried out on the market as a market transaction. What else is not counted towards GDP? Second-hand trades. So second-hand markets are not included in GDP. So let me go back just for a moment to this definition. So what is GDP? The value of all final goods. So I omitted a crucial word, final goods and services produced by residents. So that means all goods that are not new, all goods that are being sold the first time and then being resold by somebody else, this additional transaction is not included into the GDP. So why is that a problem? So that's a problem because second-hand markets are very useful. People derive economic value from engaging in second-hand transactions, buying and selling goods. Whenever you buy a second-hand car or any other second-hand product, you are better off. The seller of the good is better off, yet the GDP figures do not include those transactions into the GDP figures. So that's one of the reasons why actually the GDP numbers underestimate the real level of economic well-being because they do not, GDP figures include the value of second-hand trades that are routinely and every day carried out on the markets. Also, another reason for why GDP might be underestimating the real economic wealth is the existence of black markets. So black markets, illegal markets in which people are buying and selling stuff that is, strictly speaking, illegal. And yet, who are we as economists to say whether something should be legal or illegal? That's not our job. Our job is just to look at what is going on and to assume that if people decide freely and without coercion to engage in any kind of economic exchange, that must be because they believe they're going to be better off by doing so. So people are buying and selling marijuana on black market or buying and selling any number of goods that are considered to be illegal on the market. We value neutral science. We are not allowed to make any normative judgments about people's choices. So the only thing that we can say about the black market, people trading illegal stuff outside of the economic system, is that they perceive this to be beneficial for themselves. If somebody is ready to pay $200 for an illegal product on the market, that means that particular person values the illegal product that she gets more than $200 that she gives in exchange. So then the black market creates economic value for the persons involved, and yet those trades are not included in GDP because they're illegal. So that's an undercounting of economic well-being. Now, the greater percentage of total economy is on the black market. GDP will be more underestimating the real economic wealth. So in really corrupt and not very well governed countries, the black market is sometimes 10, 20, 30% of the total economy. It's difficult to gauge, it's difficult to estimate the percentage of the economy on the black market, but more corrupt and less well governed the country, greater the percentage of total economic exchange will be on the black markets. Even in the best run countries in the world, like Scandinavia or Canada or New Zealand, you have 2, 3, 4% of the total economy which is on the black market. So the black market activities sometimes, very often, underestimate the real economic wealth. Another thing that is not counted towards GDP is the intermediate goods. So what are intermediate goods? Intermediate goods are those goods that are being traded before the stage of their transformation to final consumer goods. So an intermediate good is anything that is used in the production process, but is not a consumer good itself. So human labor is an intermediate good. Plastic and steel as materials are intermediate goods. Flour is an intermediate goods because all of them are used and necessary to produce final consumer goods that we need: cars, bread, food, clothing, and so on. So why intermediate goods are not counted in GDP, why trades or exchanges of intermediate goods is not counted? The simple reason for that is actually that we want to avoid double counting. So whenever I imagine that I sell you a certain quantity of flour, you pay me for that flour, then you use flour and combine it with certain other goods and services that you bought from other people, and then you sell total cost of $200, and you sell bread for $210, $205, enough to get your profit. But actually, this $200 that you get paid actually reflects the value of all component parts, all intermediate goods that you used in the process of production. So then we are not going to count 2 times the same value. It is already accounted for in the final act of consumer purchase of bread. So that's the reason why the value of transactions with intermediate goods are not included in the GDP figures. But they're very important actually when you look at the value of all of these trades, that a significant portion of the economy is trade exchanges in intermediate goods. And finally, the value of leisure time. So that's one important consideration here. So the question that we may ask here is, imagine that in one country you have $3,000 average income per capita or per person, and they have, let's say, 60 hours of leisure per week. And you have another country with $40,000 of income, but they have only 30 hours of leisure per week. Which country is economically better off? So it's difficult to tell. So the usual example that is invoked here, actually Americans are wealthier than Europeans. That means the monetary income, the real value of goods and services that Americans can buy for their income is greater than in Europe. However, typically Americans have less leisure time than Europeans. So now, to what extent we can use then GDP as a real measure of economic well-being, because your and mine economic well-being doesn't depend only on the quantity of money that we have, it depends also on the amount of leisure that we have to use the money that we have. So the final purpose of earning an income and having wealth is not just to have your bank account swell. The main reason for having wealth is to use it for something that will satisfy your consumer needs, to travel, to buy stuff, to enjoy spare time, to go to Thailand, to go wherever you want to do. So more leisure time you have, greater economic benefits for you are, greater your ability to enjoy the benefits of your higher monetary income. So how to balance then the leisure versus earning income? That's a difficult thing to say, but the one thing that we can say for certain is that the value of leisure time is an important component or an important aspect of economic well-being, and that it is not counted in GDP. So that's another limitation of GDP as a measure of economic well-being. Okay. Now, imagine, so I said higher GDP, wealthier the country, higher the real income of a country in principle. And I told you at the beginning that there are some complications here, that this is not enough actually, that we cannot end our analysis there. Now we're going to see what is this complication. Imagine that your income was $50,000 per year, and that it increased to $55,000 next year. Does that necessarily mean that your real wealth is going to increase, or that your real income has increased? It depends. It depends on what? It depends on inflation. So if inflation rate is higher than the rate of growth of nominal income. So what is nominal income or nominal GDP? That's the monetary value of all goods and services sold in a given country at current prices. So that's an important addition here. So the nominal GDP is the value of all goods and services sold in a given country at current market prices. So then, if we assume that the level of market prices, we'll see later on how market prices are measured, the level of prices in an economy, but if we assume for a moment that we know how to measure the average price level in an economy, then if we assume that this average price level is constant, doesn't change, then an increase in nominal income, if the price level stays the same and your income increases 10%, your real income would increase 10% as well. which means that the value, that the purchasing power of your money, amount of goods and services, amount of real goods and services that you can purchase for your money is going to increase that by that percentage. So if your income in our hypothetical case increased from 50,000 bucks to 55,000 bucks, that would amount to 10% increase in nominal income. If the price level remains the same, this would mean that not only your nominal income jumped by 10%, but actually that the purchasing power of your nominal income increased by the same amount, which means that you now can really buy 10% more of real goods and services, whatever goods and services you want to buy than before. Okay, so that is the case if your income increased and the inflation rate remained the same. So now what if you have a positive inflation? If the general price level increased? And now there is a difference. Now it's not enough just to make sure that your nominal income increased. Actually, in order to calculate your real income or your real GDP of a given country, you have to correct nominal GDP figures for inflation. So if inflation rate is positive, then your rate of growth of real GDP or real income will be less than nominal rate of growth. Okay. So that's if your income increased 10% and inflation increased 3%, then your real GDP would be increasing by less than 10%. We will see how much less. So what is the general formula for calculating real GDP, real income? So that's on the third row here. Is the nominal GDP divided by something called GDP deflator. I will explain in a second what is that, multiplied by 100. So what is the GDP deflator? GDP deflator is something similar to a consumer price index. It's a measure of a price change in the price level of in a given country. And it is calculated as a 100 plus inflation rate between two years or 2 data points. So if your income increased from 1 year to another, but let's say $1,000, so this nominal GDP growth, imagine here. So you want to calculate how much your real GDP has increased, you as a country. Your nominal income increased, nominal GDP increased by $1,000. So now we said if the price level were stable between, let's say, 2019 and 2020, then the nominal GDP growth would equal real GDP growth. If nominal GDP increases 10%, the real purchasing power of goods and services, the real purchasing power of your income, the amount of goods and services you can buy for it, will increase 10% as well. So this formula reflects this basic insight here. It says if nominal GDP increased by a certain amount, you divided that then by GDP deflator, which is calculated as 100 plus inflation rate. 100 is the price level in the previous year. So let's say that you want to calculate an increase in real GDP between 2019 and 2020. So then how you do that? You first calculate the difference between nominal GDP in 2020, let's say $55,000 in our case, minus nominal GDP in the previous year. That would be 50,000, so $5,000 if your rate of is your nominal GDP growth. And now you want to see how much in real terms your income has increased. It increased $5,000 in nominal terms, but now you want to see whether you can buy $5,000 more goods in prices of 2019. It increased 10% from previous year. You want to see whether you can buy 10% more goods and services. How you do it? You divide it by GDP deflator and multiply by 100. So now you see, if the price level hasn't changed from 2019 to 2020, remain the same. So then GDP deflator is going to be 100 plus zero inflation rate. Inflation is a change in the price level. So the price level in the year 2019 would be 100. That's a convention. We take it to be 100. And then if the inflation was zero, then you have 100. So then if there were no inflation between 2019 and 2010, your nominal GDP, your real GDP would increase by $5,000 divided by 100 multiplied by 100. So 100 and 100 cancel each other out, and you get that your real GDP equals your nominal GDP. $5,000 equals $5,000. However, if you had positive rate of inflation, which means 3%, for example, so then you at $5,000 of nominal GDP increase divided by 103 now, multiplied by 100. So now obviously this is going to be a smaller number. If you divide the same number by 103 and multiply it by 100, then that's going to be a little bit less than $5,000. It's going to be maybe 5,900 or something like that, depending on calculation. So you see why GDP deflator is called GDP deflator, because it deflates, it reduces nominal GDP in real terms if there is inflation. So then what that means, actually, if you have positive inflation, the same amount of money in the year, the same nominal amount of money in the year 2020 will buy you less real goods and services than the same nominal amount of money in the previous year. Okay, so that's the way how you calculate real GDP growth versus nominal GDP growth. Okay, the next thing. This is one interesting model, one of the basic macroeconomic models, and this is the last important thing that I want to talk about today. The so-called circular flow diagram. So what is the circular flow diagram? That's a simple, straightforward macroeconomic model describing economic activity in the economy as a whole. So you know that every economic model is a useful simplification of reality. So this model is no exception. It actually simplifies or abstracts for certain complications. For example, you don't see the government or financial markets here. The inclusion of these elements would have complicated the pictures. So we want to isolate actually just the interactions between households and businesses and to see what are the consequences of that for the macroeconomy. So to see how the flow of income and real goods and services go between firms and households. And this is a useful model for understanding the macroeconomic problems of recessions and depressions and so on. And you will see in a moment how and why. So you have on your left-hand side of the diagram households representing all families in an economy. On the right-hand side, you have a simplified version of all businesses. This is the economy that produces for the market. Households are the closed economies that might be producing something for their own needs, but they're not selling anything out of the market. So that's the basic analytical difference between households and firms or businesses. Households are closed economic units that might be producing something for their own use, but are not selling in principle anything on the market. Businesses are producing and selling for the market. So how the flow of exchange goes between these two economic agents? You have two different flows that go in the opposite directions. The pink line represents the flow of resources in goods and services. and the green line represents the flow of money in the economy, and then go in the opposite direction. And I'll explain you now how that works. So you have households, you have people living in households. They are owners of land, they're owners of real estate, they're owners of their own labor. They also have certain amount of money, income that they can save, and they have entrepreneurial capabilities. So these are real resources that households, that people living in households have at their disposal. So they offer these to businesses, offer the services of their factors of production. So these are factors called factors of production: land, labor, capital, and entrepreneurship. Okay, so the individuals offer these services of their factors to the businesses. For example, they offer their capital through the banking system to the entrepreneurs who borrow money. When you put your money in a bank account, this money doesn't just sit there. It is actually transformed by the banking system into loans for the businesses. So that's how you provide services of capital goods to the business firms. Labor, also, you are selling your labor to a firm is purchasing these services. Land, you are selling or renting your land to somebody, or renting or selling raw materials, natural materials, to somebody, to some firm. The firm is buying that. So this is the first side of the transaction on the factor market. As you can see, this white red arrow here, it's a factor market in which the factors of production are traded. So what the households get in exchange for offering the services of their factors to the businesses, they get factor payments or factor incomes. So you can remember that these four: rents, wages, interests, and profits, are factor incomes. That are payments that the individuals living in households receive from businesses as a compensation for providing the services of their factors to the firms. So rents are compensations or factor incomes of land. Wages are obviously factor payments to the services of labor. Interest is a payment for providing capital. So that's the reason why they pay you an interest. One of the reasons why they pay you interest in a bank, because they can use their money actually to lend it to somebody else. And profits are factor incomes for entrepreneurial activities. If you run a firm, actually, you're going to get compensated for risk taking and entrepreneurship, and profit will be your factor income. So you see that the flow of resources goes along the pink line, from households to firms, land, labor, capital, and entrepreneurship. In exchange, the flow of money as a compensation goes from businesses to households. So these are trades on the factor markets. Now, what happens with these factors once firms get them? As you can guess, firms then combine them and produce consumer goods and services. And what they do with them, they sell them to households. So you see the flow of goods and flow of resources continues from the firms that you can think of as businesses here is a kind of black box, is a kind of closed system that just absorbs resources and combines them, then spits them out and sells them to households. And now people as consumers enter the market for consumer goods, or product markets for final consumer goods and services, and they receive goods and services from business firms. What business firms get in exchange? They get sales or revenues from the households. So this is the circular flow diagram that explains the basic model of a macroeconomy. What is the most important thing here to have in mind is that you want, as a government, you want to maximize the flow of resources and money in your macroeconomy. So everything that reduces the speed and the strength of money circulation is bad for your macroeconomy. Either the payments of profits and rents and wages or consumer spending. Here, everything that reduces the flow of money is a bad news, is a bad thing for an economy. Everything, conversely, that reduces the flow of resources or slows down the flow of resources is a bad news for the economy. So you want to do everything in your power as a government policy maker to prevent the reduction in the speed and the pressure in this system, the speed of circulation and the strength of circulation of money and resources. So how you do it? So there are two different phenomena uh, that characterize the circular flow diagram. They're called injections. These are good things. Injections are things that strengthen the flow of money and resources, that increase the strength of this flow. And leakages are, as you can imagine, anything that reduces the pressure, so to speak, in the system, anything that diverts money or resources, uh, drives them out of the circulation and reduces the amount of wealth that is being produced in the system. So what are injections? Injections are consumer spending, investment spending, government spending, and exports. So you see when consumer spending increases, that's this green line here, that's a good thing because it increases GDP. It increases the total level of spending. When investment spending increases, that is also a good thing because it increases productivity of business firms. Government spending also is good for the macroeconomic system because government spending usually increases the household income, and then the consumer spending might increase as a consequence of that. And also exports. Why the exports increases? Why the export is considered to be an injection rather than a leakage? Because the business firms sell goods and services to foreign households. So here you can imagine another small house here. That's a foreign household. So foreign households are brought into the fold and they're made to make sales, to buy goods and services from domestic firms here and to receive goods and services in exchange here. So the domestic firms are not selling only to these domestic households, but if you can imagine another small green house here, that would be the foreign households or foreign businesses, it doesn't matter, that are buying goods from domestic firms. So that's an injection. They're injecting more money into the system and strengthening the circle, strengthening the flow. Okay, what about leakages? Leakages are imports, taxes, and saving. So imports, why imports? Because in that particular case, domestic households will be buying, instead of buying from domestic businesses, they will be buying from somebody else. Imagine here that you have foreign businesses, so part of the money that would have gone otherwise to domestic firms would be going to foreign firms. So the quantity of money in the system declines and the strength of the flow declines, and then profits, interest, wages, and rents will be lower because the incoming amount of money here will be lower. Taxes, that's the same thing actually. When you tax whatever, either businesses or households, if you tax households, actually they are going to reduce their consumption. Because their income goes down, they're going to reduce their consumption, probably to increase their savings. So then the amount of spending will go down and the circular flow will weaken. Saving, obviously, if the rate of saving increases, so you have $1,000 of income and you are spending $700 and saving $300 as a household. So what happens when you decide, when you increase your savings rate? Increase it from 3% to 40%, from $300 to $400, you have $100 less for spending. $100 less for spending will lead to a leakage from the system, to less spending on final consumer goods and services. Okay, so now the final thing is just one definition of the phenomenon of business cycle, and I will finish with that for today, and we'll open a discussion group on Canvas for you to ask any questions about the lecture thus far. The definition of business cycle, so that's something that is very, very much topical these days. So business cycle is a phenomenon of short-term business fluctuations, which means short-term changes in the level of GDP in a given country. So contraction or a recession. So a business cycle has two phases. It has a phase of boom or expansion when GDP is growing, and has a second stage, which is downward phase, in which the real GDP declines. And this downward phase is called contraction or recession, and it is usually defined as two consecutive quarters, two consecutive 3-month periods of negative real GDP growth, which means real GDP is declining. In 2 consecutive quarters, we technically define that as a recession or contraction thing. Then once the lowest point is touched, that's called through, at the lowest point of the business cycle, and then the recovery starts when real GDP starts increasing and eventually reaching the previous level and increasing still further. So these are short-term business fluctuations. Short-term because they usually last for 6 months to 1 year, sometimes 2 years. The longest business recession, the longest business contraction in American history was the infamous Great Depression of early 1930s that lasted for about 4 years. So usually recessions are short-lived phenomena. The last recession lasted about 18 months in 2008, 2009. So these are short-term fluctuations. Long-term fluctuations are something else. In the long term, in the long run, recessions are not so much important because what counts in the long run is actually the average rate of growth per year. And America had quite a few recessions in the last 100 years, but the average rate of economic growth was 3%. So if you invested in government bonds or in any other, in the stock market 100 years ago, the value of your investment would grow at an average rate of 3% per year. So that means that in a recession, you would lose sometimes 20%, 15%, 30%, depending on how big a dip in the stock market is. But in the long run, you would be earning an average rate of return of 3% or 4%. So that's why the long-term economic growth is more important than short-lived fluctuations, especially if you want to save income for retirement in the long run. So in that particular case, you are not terribly worried about a recession. You shouldn't be terribly worried about what is going on with the stock market right now, because simply what counts is actually the value of your assets 30 years down the road. And if there is a predictable economic growth of 2, 3, 4%, the value of your assets is going to increase by as much over that period of time, irrespective of the short-term fluctuations. Another consequence of that is that the real economic growth means that people are going to be wealthier in general. The amount of consumer goods that they will have at their disposal in 100 years will be much higher than it is nowadays, irrespective of the short-term contractions and negative changes. Okay, just one illustration of the importance of this, that the positive rates of economic growth are so important that if you imagine for a moment that America grew, that American national income grew from year 1900 until today by 2% on average. It grew by 3%. And now you might say, what is the difference? 2 or 3%, it doesn't matter. In the short run, you don't see a big difference in that. However, in the long-term period, it matters a lot. So if America grew by 2% on average in the last 100, 120 years, our national income nowadays per capita would be equal to the income of Mexico. So that's how much even a small increase in the long-range economic growth is very, very important for the long-term economic prospects of a given country. Okay, so that's all I've got for today. We're going to continue, and eventually I'm going to post the PowerPoints that you had a chance of looking today on Canvas for you to consult, and the lectures will be permanently recorded on YouTube. Okay, so bye-bye for now, and I'll see you on Thursday, 9:30. In the meantime, you're free to comment and to ask questions both on Canvas or on email.